The opinions expressed in this presentation are for general informational purposes only and are not intended to provide specific advice or recommendations of any individual or any specific security. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. The information is given in summary form and does not purport to be complete. While due care has been used in the preparation of this presentation and the information contained herein has been obtained from sources believed to be reliable, its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of Willow's control. Past performance is not a reliable indication of future performance. All right. So with that, we'll jump in.
All right. We're going to start with our risk metrics. And as always, we look at the yield curve. Inverted yield curve usually means recession. Although this has been going on for well over 2 years now that we've had this inversion. One of the things that we always say is it depends upon where you are in the socioeconomic ladder, is depending upon if you're experiencing a recession. We would say our clients who are retirees, who are living on our fixed income, are in a recession. So it's a very bifurcated, very odd, we think, time right now. Definitely. And in our work, even though the numbers may not necessarily show a recession, we do know that there are greater and greater numbers of our population in this country that are experiencing what we would call a recession.
Absolutely.
Yeah. Now, the truth is some companies are making a ton of money, many of them, and basically they're taking advantage of inflation. And the perfect place that you see this, I don't know if we talked about retail numbers in here, Paul, but a perfect place that you see this is retail sales came in higher than expected. Well, of course, because it's based on your receipt. So they take a sample of the receipts from many of the major retailers across the United States. And of course, because prices are up exponentially, it shows that retail sales are higher. So, it's a smoke and mirror in what we consider smoke and mirror. The truth of the matter is, however, is there are companies that are exploiting this opportunity and are making more money. So in theory,
everyone experiences this greedflation and shrinkflation. Right?
Exactly.
You go and buy a box of cereal, there's even less cereal in it.
Yeah.
There was a few weeks ago.
He's feeding a family of 5, so he really
grocery bills
really
have only gone up. They have not come down.
Let me go to the local farm and I get my produce. I can't wait. Anyway,
just wanted to show on this chart too. The blue curve is the most recent, so this is as of a few days ago, and the red one is last month, and the olive colored one is from last year. And so you can see that overall yields have actually increased across the board, even though there's been so much talk in the news about Fed's gonna cut rates, they're gonna lower. We've been saying, no, that's not gonna happen based on the data that we're seeing. And this is the proof right here. Also, when you see the long end of the curve, these are like further dated out treasuries, so bonds that mature 5, 7, 10, 20, 30 years from now, as opposed to the left side, which is bonds that mature in 1 month, 2 months, 3 months. When you see that long end rise, I believe that's called a bear steepener curve, and traditionally that is not a great sign for the health of the future and what future expectations are.
But we've been running like this for 2 years. But one of the things that we want to say is that we still hold that rates are not going down. We don't care what they say. We think it was political posturing last year because they announced it way too early. All of our indicators actually showed that inflation is only going to go higher, not lower, because you have to understand we now have which we feel never remedied, the supply issues, which are only getting worse because of conflict. Okay. And because of now the bridge in Baltimore. I mean, we can go on.
So many pieces that affect that supply chain. And anytime those supply chains get disrupted, it results in inflationary pressures that get passed on to us consumers.
Yeah. And we, I don't know, 2012, I wrote about many things that are happening today, and it was all based on like policy and, And a lot of these things are happening. And one of the things that in our work we're seeing right now is we think energy is at a better floor than a ceiling. So we think, that's going to be the wild card here. And again, the conflict just speaks to that. And then policy speaks to this too, because we're putting in some policies that just make no sense and will only increase the price of.
A lot of head scratchers lately.
Yeah, a lot of head scratchers. I think, they're talking about releasing more energy from the SPR, from the reserve, which we're dead set against. Simply because, we're at the lowest level we've ever been at a time when there's so much conflict around the world. And it makes us question, like, are we trying to be sitting ducks? Honestly, it's a little scary.
You have to wonder.
You have to wonder.
So moving on, oh my God, how do I get rid of this? Oop.
What's wrong?
I've got this, oh my goodness, what's happening?
Don't worry about the line.
Next. Yeah, I drew this little thing.
Okay, don't worry.
Anyways,
about it. It's
just
okay.
ignore that. Bond spreads, another measure of risk, but these have been getting tighter and tighter for a while now. For a couple of years, they've been tracking.
So this is important again, because this speaks to, what kind of credit risk is there in the markets right now. And, in the private industry, it's not showing much risk, and in the US treasuries, it's not showing, well, it is showing more risk in the treasuries than it is the private market. But this is usually a very good indicator of what.
That's a great point. It makes me wonder if these spreads aren't blowing out, meaning the spread between an investment company or investment grade corporate company versus the treasury bond. And so when those spreads widen, it's saying, hey, I need to be paid a higher premium in order to
take the
risk of buying a corporate bond as opposed to a government bond, which is supposedly super safe. When that gets really tight, it says that the difference is less, or there's less risk to go into it. And so I actually wonder if with all the US debt printing, and as we've seen rise in CDS spreads for the US markets, that the floor for US risk has actually increased. So even though corporates have come down, that floor has come up. So the spread between the two is less.
Possibly. That's something we'll examine for the next call. I think that might, I like the way we think.
Yeah.
But what this shows to us is that at this point in time, if we stick to credit quality, which we are staying with right now in the corporate market, that we should be fine. The other thing, the previous slide showed us to continue to maintain our short posture in bonds, because we're not getting paid to go long term. And then, of course, our thesis is that rates aren't going lower anytime soon. So, we want to stay in that shorter end of the curve with quality. Oh, we're having a little latency. Yeah. So, we'll just breeze through, because,
we can,
again,
although they did start spiking.
Just a little, but nothing.
Not major, but it is a change in direction. So it's something.
And we always watch directionally where things go, but the slope of the curve is equally important as direction. Spreads.
This dark green one is Kohl's. So it makes sense.
I'm sorry. I think Kohl's isn't going to be a company with us. This is just my prognosis. I don't think Kohl's is going to be a company that's going to be with us in 10 years, So
these are corporate credit default swap spreads. Again, another risk measure that we watch. When you see these shoot up, it just says risk of default has increased significantly. Most of these have been trending down. A few have started to potentially spike back up, but it still doesn't look super concerning at this point.
And then this is spreads for US sovereign debt. And you can see the spreads here are greater than the spreads in the private market, so that's saying, and one of the things that we talked about, and I think a lot of is when we had the financial crisis, we took a lot of the debt off the private industry and put it squarely on the debt of the government. And then, of course, all the money printing we've had over that time. And of course, now we're funding several wars. So it makes sense. Our debt, where is it right now, Paul? What's our debt service? What was it? How many trillions was it? It's over GDP. Oh, I don't know. Do we have it in here?
We might.
Oh, I hope so. Because our debt service is greater than our GDP at the moment. Yeah. I don't think you run your household that way, hopefully.
No, hopefully not. So this is another chart of multiple credit default swaps for different countries. So the risk of different countries essentially going default on their government bonds. These have been trending down generally, although again, there's these little spikes up.
Nothing.
Nothing to worry about yet. I mean, if these continue to go way up, then yeah, that's a problem.
Just, just so you know, we're seeing everything every day. And there's like how do I put this? There's a feel in the bond market that comes before anything really happens. Okay. And these charts, we show them just because the charts are important to us, but you have to know, because we're trading real time, we can feel into what is happening. It was so clear, like, for example, in 2000 to get out of Enron and WorldCom, and in 2007 to get out of Lehman and Bear Stearns. These charts, they reflect something, but the feel of trading when you're in and you're trying to get a bid, or you're trying to sell a bond, and you're seeing that the dealers are bidding them down, you can see right away something's going on. Because we have not had that problem, truthfully, since the financial crisis. Doesn't mean we'll have it again, but the bond market is a great predictor of direction.
Just want to bring this point up to give some insight too on how Alexandra and I think. We were just talking yesterday about Brazil and some of the charts that we were seeing and some of the issues that were brought to our attention there.
Yeah.
And now look at this dark blue. This is Brazil. Spike. We're starting to, right. Interesting.
Yeah. We think something's going on there. Something, the charts are definitely showing something. Inflows of money. So this is money markets.
A little bit right now, looking at money markets and liquidity and just how money flows and who's buying it, right? This is a chart that shows money market inflows, or how many dollars are being held currently in money market funds. And you can see, since the Fed started raising rates, obviously people are thinking, hey, I can get out of my savings account and into a money market fund and get a much higher return on my cash. And that trend has not stopped.
And this is disintermediation from the banks, right? So it's literally disintermediation from the banks into Treasury. So we're funding all this debt, cool, through our money markets, right? Because, well, not all, because there are some that are not, like, there's prime and non-prime. Oh, these are prime.
This is, so the blue is prime, or no, the blue is government money market funds, and the red and darker red are prime.
Okay, but so those are still growing. So so we are in government money markets. So we are funding so many things. So this is disintermediation. Why this is a big deal to us is it an indication of economic growth going forward. So if money's coming out of the banks, remember, the banks are the ones that are funding small businesses, which, by the way, I don't think we have the survey here, but small businesses are really struggling. Oh shoot, next month we should really get those in here. Okay. Because remember, that's the lifeblood of our economy. That was what, 60 to 70% of our employment around the country.
Yep. Small businesses.
Yeah. And they are under pressure. Now, remember, Paul and I have a theme here. Big is getting bigger. We call it the bugs. That's our acronym. Big, ugly, we can go on. But big is getting bigger. Small is getting smaller. That is not a good sign long-term for any economy that rolls in that direction. That's the lifeblood of our economy. That's what makes us so,
with this increasing, it's saying that smaller banks have less and less cash on hand that they can then loan out
to the small businesses
who need it in order to grow and fund operations.
A trend that we want to talk about actually is in real estate. So, again, our prognosis for real estate is that you are going to see larger and larger players take over the rental market. Okay. So that there's less and less mom and pop shops that own real estate. Okay. And this is happening at a very rapid pace. So you see, like, BlackRock, you see Amazon now has an offering to people so that they become landlords. Okay. So you could buy X through Amazon, and Amazon will now be the landlord. Okay. Don't do it.
That speaks to a larger trend of just the sort of hyper financialization of everything, where if you can find a way
control
to trade it right, and then it really consolidates power and gives control to very few.
Too much.
There needs to be a good balance.
And so this disintermediation, again, less money for the banks to lend to the small businesses. You can definitely say, I don't think we did the senior loan survey this month. Okay, we'll do it next month. So we're really going to take a drill down into small businesses next month. Yeah, that would be great.
So just to touch on this, the Fed had a window open, the BTFP or whatever it was, that was to provide liquidity for banks because they're holding on to these bonds, these long dated bonds. Then they raised the interest rate. So the price of those bonds went down considerably. So the banks, not only are they experiencing this huge outflow of cash into money markets, also the value of their bond holdings has been cut almost in half in some cases. They're sitting on these huge unrealized losses. So these banks need liquidity in order to continue operations, make loans. And so they tap different Fed windows in order to get that liquidity. One of these was the BTFP, where they could use, but that program ended last month.
End of March.
Right. And now we've been postulating and thinking about, well, we're going to see what happens soon because of this. The other place that a lot of banks go to get liquidity and whatnot is the repo window. And this just shows the reserves there that were previously huge have come down considerably, less than $500 billion. I mean, at one point it was $2.5 trillion.
Yeah. So, why do we pay attention to this? Because this is liquidity again, and we expected the market to react to this. We both said, wonder how the market's going to react at the end of March when they pulled this liquidity from the market, which is what they did. And, so we don't have like that liquidity cushion that we had before. Now, admittedly, the Fed creates some of these stealth programs that are not necessarily public, but we do know about them. But there's not a new one they announced yet.
Not yet.
So we'll see what happens. It's an election year, so there's all kinds of funky stuff that happens in an election year. Yeah.
This chart just speaks to those losses, those unrealized losses that banks have on their balance sheet. You can see it.
So yeah, so that's really important because that's part of the reserve, is these losses. And this is actually what part of created the problem with Silicon Valley Bank and Sterling Bank and all that. But anyway, we think that the larger banks are going to benefit from this, and interesting, JP Morgan announced their earnings. That's right. And they announced that they were having a problem with their net interest margin. And so that is just not problem, but they didn't make as much money because of their net interest margin. But that speaks to that arbitrage. Some of you listened last month, Paul talked about the arbitrage that they had where they were going to the window, borrowing really small and then lending big. So that arbitrage opportunity is gone. So we'll see how that affects these companies.
And if you're curious, you can see how this could lead to things. I mean, it did lead to bank failures, but the reason why is if your bond portfolio is now cut significantly in its value and you have this massive outflow of cash into money market funds, and then you have a bunch of depositors come in and say, hey, I'm moving my money to get out of here, it can snowball very quickly because now the bank says, okay, our cash reserves have been decimated because it's all going to money markets, and then our bond portfolio is worth half of what it was. So now we have to start selling these bonds, are forced to sell them at a huge discount in order to give our depositors their money back that they're moving, and that can just
make sure you stay under that FDIC limit. That's really important. I think that's like the biggest takeaway that we can say to you here. And, check the safety and security of the bank that you're working with. And if you have any questions, let Paul and I know, and we'll look at what bank you're working with. Okay. We know our local ones, but it would be good if if you're out of the area, share with us what you're doing. Okay. That's what we're here for.
This is just a chart that shows private credit around weekly loan flows, weekly loan fund flows. So money going into private equity funds.
Right? Yeah. That right. Basically private equity funds funding businesses. And we're seeing a big trend in that direction. Okay. And this may be why we're not seeing spreads change in our work. Okay. But anyway, so you can see more and more things are coming out of private equity, again, making the consolidation of power and money in a very select group.
Right now, instead of these smaller banks saying, okay, I can issue these loans to all these people, since they don't have as much capacity to do that, private interest has been stepping in to fill that void. But ultimately that, to your point, consolidates power, right? Because not everybody can play or access in that field. All right.
And data. So now we did risk. Now we're looking at data.
All right. here is the leading economic index. We like to track this month over month.
Yeah.
We're still deeply in this negative territory here. Yes, it's rounded out. Typically, when you see these start to go back up, I think historically that's when the NBER or whoever makes that call officially declares recession. I think it's when the curve changes, right?
Yeah, who knows? I mean, I just know that,
Mhm.
we're negative. We've been negative for a long time, and yet there's no recession.
Right.
So, okay.
All right.
Okay. But here's the components. Okay. And the components can't lie. So this is the truth. What 3 months ago we only had, so this is the components to that leading economic indicator. And what 3 months ago we only had one data point to the positive, to the right side of that line, and that was the S&P 500. Now we have more components to the right side of that line. And we think that is coming from like the industrial space, which by the way, we initiated new positions for you there, because our work before this whole Iran-Israel thing is happening is that, I mean, I'm just going to say it. Our work a couple weeks ago showed that there was going to be a broadening of conflict. Simply because of the types of sectors that we're leading. We do have that question that we will answer in a moment. But anyway, what you see is this change in the leading economic indicators to the right side of this equation. That's a big deal to us, so we'll see how that all works out. So basically the S&P is higher. You can see like building permits are up a little bit. Average weekly hours are up. Is that up this month? Or is that down? Like which one's blue is now, right? Yeah. Okay. Yeah. So we'll see what happens as we go forward here.
And I see things like this, like new orders index, still down.
Still down. Yeah.
Consumer expectations for business conditions, still down.
Yeah.
Those are important. You want a confident population. You want people to feel good about things. And sometimes you can fake it till you make it, I guess, in this economy where if everyone feels that everything's good, it's going to eventually
fake it till we make it
to the data, right? But the data is just showing that that's not the case.
Yeah. All right, let's see what we got.
All right, CPI. So this, so we've been saying, so first off, a lot going on in this chart. This is just a CPI broken out by the different components. So it shows the different colors of energy, food, core goods, and core services. What we're seeing, and we had multiple conversations about this on how energy was leading, and then the price of oil dropped significantly, and it led to this sort of deflationary or disinflationary pressure down here. But now it's back up again, and we've been saying for a while that energy looks like, especially given decades of policy and everything, that the prices are on a track to move higher over the coming years.
Yeah, I think so.
And it's going to continue to put pressure on inflation, which we're seeing, and which the last CPI number clearly shows that, hey, look, now energy is causing it to go up again.
And same with food, and again, to Paul's point, shrinkflation. So he has to buy 3 bags of chips for the 1 bag of chips he used to buy for his children or whatever it is.
I know my grocery chip, I'm getting the same amount of groceries, but the price just keeps going up and up and up.
All right.
So
where are
looks at
prices
where are
rising?
pricing the most over the past year. Insurance, number one.
Yeah. So, you'll look at this and it's really weird.
Healthcare, rent, electricity, housing, food away from home,
all things that we need.
All the things you need. And then the things you don't need, televisions, toys, car rentals, smartphones. The prices on those things have come down.
Yeah. And I mean, I don't know if they really came down. I don't know. but So essentially, again, getting to our longer term theme that the prices for necessities are going to go higher. Again, we think it's intentional. It was so predictable in our work for years. And those of you who have been listening to us for a long time know we've been calling this for a long time. And it's painful because this, like, again, this affects our family here in the United States. It affects our citizens, our fellow citizens. This is affecting them. And this leads to stability in our work for sure.
Right. These are the seeds that plant can plant problems down the road. I mean, there's a great uh, there's an interesting theory around the price of bread and how that is a gauge for civil unrest. And when the price of bread, especially in third world countries or developing nations, right, where food is you eat or you die, right? So when the price hits a certain point, historically, you can almost point to, yes, this is going to lead to conflict.
I think a lot of people are up in arms about the fact that power drinks are up in that, but who wants those? Anyway, no, I mean, the point being is that like this affects our clients on a fixed income, but it also affects like the new generation coming in to buy homes. I mean, it's impossible. That generation is not able to buy new homes. And no, that's just not a powerful signal. So, okay.
Yeah, for recent history, every generation has achieved or been more wealthy than the previous.
Yeah.
Except for now. This is the first time in the past, I think, 100, 200 years where the youngest generation is now set to be less better off than.
Yeah. So, here's like, I want to insert this point right here for you. Bad for the consumer, bad for the health of the US economy, bad for stability in this country overall, and darn good for industry.
Yes, right.
I don't know what to say. I hate, like, forgive me for saying this, but this is absolutely true. Darn good for industry, really bad for people. I'm all for the people. I know we manage money, but I am all for humans. I really am. Will motor vehicle insurance go up another 22% next year? Hopefully not, but this was, again, predictable in our work totally. So
yeah, here just shows car inflation over a longer time period.
I mean, honestly,
insane how quickly it's just.
Yeah, it's just really, come on. Our cars are supposedly safer too.
Right, but now they cost.
Yeah, I mean, because you have all that eyesight and all this kind of stuff, and anyway, okay, let's keep going. All right, electricity,
another one, just keeps going up. Just small business optimism. These charts are always interesting because it gives a good, right? Small businesses, they employ 70% or so of the economy. It's what makes our country really thrive. And you can see there's lots of negatives. Planning to hire has fallen off a cliff. Optimism has reached an 80. It's a very low level.
I mean, this is part of the reason Paul and I decided to merge with another company, because we knew our costs were going to be going up considerably. We also knew that we knew this was coming. So it's like, why would we have all this information and not act on it? It were so much better in a larger group. Not unfortunately, because we picked a great partner. And that's why you're still working with us. In fact, some of our team got promotions, which is fabulous, and more money, and that's all good. But we knew in order for that health to continue, we know this is coming. We know it's going to get harder to do business. It's going to be more expensive to pay for our insurance and so on. And so therefore, this was the best option. So we actually put our money where our mouth was. Right? We knew this was coming. So we're like, okay, so we're going to have to do something about this. So anyway, that's, part of the justification for it. Occupancy rate for commercial. So this is a slippery slope, I think, here is what's going on in the commercial real estate market.
Just so you know, what this chart's showing is this is a group that tracks how full our office buildings essentially are, commercial real estate, how much is occupied. And they run a survey that tracks a bunch of office buildings in 10 major cities, and it's been going down. So this is saying less than half of office buildings in the top 10 metro areas on average.
Yeah. So that what I want to point out, something here. My generation and greater. Okay. We went to the office. Okay. This is just the way it was. Talk about this younger generation and younger than Paul. Like, this is just not acceptable behavior. So we actually think this is a trend. This isn't just like a flash in the pan. It's going to go away because of Corona. No, the opposite. We think actually much the opposite.
Point to know is pre-COVID and the shutdown, this number was in the 90s, 90-ish%.
Yeah.
And so now it's how many years later and it's still
Yeah.
big shift.
Yeah. Big
Mhm.
shift.
Um,
Supply chain. I mean, this speaks volumes to us in terms of, volume and in terms of pricing. And so until these issues clear up, this is going to put pressure on prices.
Right.
So
All of this transportation around Africa instead of going through Suez it adds thousands of miles to the journeys of all of these cargo ships. That has a high cost in terms of energy.
In addition
Right.
to what we know is happening in that region in terms of safety.
Mm-hmm.
So we have that as well here. So not only more goods going through that particular channel, but also more potential for conflict and issues.
Mm-hmm. And even the Panama Canal too has dropped off,
'cause of
mostly
water.
due to environmental factors where water levels have sunk in their canal, so they can't put as many boats through. These are all inflationary pressures that another reason why we're saying
Fed can't control this.
Right.
This is out of our control.
No policy is going to really
No.
fix this part.
No.
At least interest rate policy is not going to do anything about this really. Yeah, so here's fiscal deterioration. Shows the top one shows net interest as a percent of federal government receipts.
We should be wrapping up.
Yeah, there's only a couple
Two
slides
more.
left.
All right.
Just that US federal government debt to GDP ratio, I mean, it's near an all-time high.
Yeah.
Crazy.
See, this is a problem here. We're spending more in funding our debt, right? Like servicing our debt.
A podcast this morning, and the guy was saying, U.S. government spending puts drunken sailors to shame.
Oh yeah, hey, let's go. Be a drunken sailor. Okay, so while Paul goes through, that's the wealth concentration, and that's a big deal. So let's talk. We do have a question. I'm going to just roll through Paul because I think we're getting a little late here. We got time. Okay. Do you want to talk about this? Go ahead.
Just that insider activity. So this is directors, C-suites. Anyone else really included in that?
Oh, I mean,
higher ups at companies, publicly traded
management.
companies, management and higher at publicly traded companies are more bearish than any time in the past decade. This just shows who's buying versus who's selling. And so when there's more sellers, right, this chart goes down.
Yeah, and you can see like 2017, 18, they were more bearish.
Here.
Yeah.
Corona was around here.
Yeah.
Actually, there's a lot of buying.
Yeah, a lot of buying in Corona. So, and then the S&P. Yeah.
There's just like three.
Yeah, go ahead.
Yeah, this just shows breadth of market. And it was expanding. When this goes down, it says there's broader participation, that more and more companies are participating. When this goes up, it's saying it's really concentrating in the largest companies in the index, which is what's happening. I mean, this is almost a new peak or a new recent high in the past several years. So again, it speaks to our whole, what's this going around consolidation.
Yeah. So,
gold, right, hit a new all-time high. If things were so good, gold, which is historically seen as the safe haven asset, why is it hitting new highs?
Which we do own for you, and we've had it for 2 years.
Yep, we've owned it for a while.
Yeah. What else?
Crazy.
The crypto market.
Yeah. So it's been.
Well, let's talk to that in a second. Just I want to summarize all the other stuff first. Yeah. We'll talk about crypto in a second because I want to just address how are we I think most of we're realists, okay? And so our job is to look at everything for you. What we also know is in every situation, there are opportunities, okay? Like, for example, we bought gold for you, and you can see gold is hitting a new high. Also, we recently bought some industrials for you. Somebody asked about what sectors we like. Well, frankly, this is one of them because we actually see some opportunities in there, like a Cummings and an Emerson. There's a replacement cycle that we're going through.
A lot of electrical component focused companies are performing phenomenal right now.
Right. So there are these opportunities. And so like areas that we like, gold, industrials, crypto, which Paul will speak to in a second. Okay. And somebody asked the questions like, do we like miners? No, we don't like miners. We rather own the gold, the
Own the
commodity
commodity
itself.
itself.
Yeah,
Yeah.
that's much better for us. And this is a hedge against what Paul and I knew was coming, was this level of political disruption, this level of geopolitical issues. Sorry, it was predictable in our work. Okay, so this is why we bought that as a hedge for you. Okay, so
and miners can be much more volatile.
right.
Mines can think that they've struck a gold vein, right, and then it turns out to be nothing. And when you historically watch the two charts between the commodity and the miners themselves, typically the miners are all over the place and usually don't perform nearly as well as the commodity.
So there's always an opportunity, and that's what, and very frankly, just because we're discussing the long-term effect of how, all of these policies are not positive for the United States in the long run and for this economy. Again, the point being is it's good for business. Unfortunately, there are companies that are absolutely benefiting, and this is why we are sticking with the biggest companies,
largest companies.
There's
certain sectors that we like.
Technology we still like. It depends upon what it is. Industrial space, that's a new ad for us. Gold's not a new ad, but where else? In some of the healthcare area, depending upon where it is, we're very selective.
Right. Because that's another trend we've noticed too, where really in the past it's been a rising tide has lifted all boats, but as you can see with that
there's a bifurcation
chart, it's really within each sector there's a couple of winners or a handful of winners, and everybody else is losers. So
So this is in a nutshell how we're thinking about the market, and we're putting you into the pockets that we know and feel comfortable will do okay in this next time period. And know that we're always looking at the risks and everything else. These things have been coming up for a long time. This theme going into the bigger, and the slide that Paul showed you where the larger are outperforming the rest. This has been going on for a while, with the exception of at the end of last year, a little bit of the beginning of this year. And frankly, Paul and I are thinking, is there a shift? Is there a change? But we need it to. It can't just be like a shift and a change for a month or 6 weeks. We need to see a broader shift for a longer period of time. And then we'll know that this is the next trend. We don't have that.
Hasn't happened yet.
So, does anybody want to raise their hand and ask a question? So somebody asked about what sectors we like. So industrials, the metals, depending upon what it is, select healthcare,
some energy.
We really like energy. We're in energy, and mainly the gas companies, because the master limited partnerships, which unfortunately delay your taxes, but 6, 7, 8% yield, and they're performing really well.
And they move in these longer term cycles.
And they are not levered to Saudi Arabia. They're not levered to the Middle East. They're actually here. Okay, so that's one. We do have a holding which is levered to the Middle East, which would be Chevron, I think, which we mostly have in many portfolios. But energy is the other one that we do like. Utilities, no, not so much. Discretionary, because we do think the consumer is having a bit of a hard time.
And remember too, everything moves in cycles. And so while some of the things longer term might make sense when you really sit and think about it, right now is not the time to get into some of these things.
No. Okay, so if you have a question, please raise your hand. In the meantime, Paul is going to talk about, we got a question right here. So we're going to let you talk. So go ahead. Oops. Can you unmute yourself?
Hello?
I don't think you're unmuted.
We can't hear you. If
Can you write it in the chat?
There's a little chat you could type it into.
In the chat.
Okay.
Yeah. If you would be kind enough to put it in the chat, please, that would be fantastic. Or even if you want to call the office, you could call 413-236-2980 and ask the question out there, and they can bring it right to us if you don't mind. 413-236-2980. Okay, or just type it in. So while
that happens, I'll briefly just update you on the crypto space. Bitcoin has a halvening coming up. It just means that the supply that's issued to miners gets cut in half. Historically, this is a 4-year-ish cycle. Every time this has happened, the price has run up pretty drastically within the following 18 months. When you look at something like the crypto market cap or all of the money so far that's been invested in that space as a whole, when you look at it logarithmically, it's pretty much a straight line like this, meaning that this is potentially an exponential technology that is still gaining traction and is still gaining support. There's the phone call.
I think that's going to be a phone
Hopefully.
call. I'm going to double check. Keep
Mhm.
talking, Paul. I'm going to check on this, okay?
Yep. So if anyone has any other things too you want to type into the chat, feel free.
About the ether and the GPT.
Yeah, the things that make us very constructive on the crypto space as a whole is that you have companies like BlackRock and Fidelity who have now launched ETF products that really expand who has access to this space. When we look at the net inflows to this, recently, all the combined flow into Bitcoin ETFs had surpassed GLD, which is a gold ETF and a major gold ETF at that. Billions of dollars flowing into this space. Some other major updates that have happened are Hong Kong, a major financial center of Southeast Asia, and really the world at large has just approved Bitcoin and Ethereum ETFs, which should launch in the next few weeks. Just the fact that we're seeing these major financial players really step into this space is just one more check that says, yes, our thesis around this is playing out as we expected it to. Extremely volatile, right? I mean, if you've been watching the price of Bitcoin, it dropped something like, I don't know, 20 or so % over the past month. Maybe not Bitcoin, but other cryptos have. But that's what we expect in this space. It shakes out a lot of people who jump in trying to capitalize on the hype and then realize, oh, this is not something you can just buy and cross your fingers that it's going to go straight up. It doesn't really work like that. So we do believe in the space. We have a small allocation to it, and it has been performing exceptionally well, even in light of these recent pullbacks in the space. Due to some of the geopolitical issues, the space as a whole still really is looked at as a risk asset. That's really pretty far off on the risk curve. I mean, we would probably make the argument that it shouldn't be that far out or perceived of as risky as it is, granted that the volatility is there. But when you look at the underlying nature of what the asset does and what the impact that it can have or will have most likely over the coming years is shouldn't be ignored. So got another question here. How confident are we with Coinbase as an exchange? That's a great question. Personally, I own Coinbase. I think I do a lot of transactions personally through Coinbase. I feel fairly confident. I know that through following the CEO for the past several years, high integrity person who has a much grander vision really for what Coinbase can be. Now that said, do they have outages every once in a while? Yes, absolutely. When demand spikes, do they have trouble, sorting all that demand? Sometimes they do. But as far as I'm aware, especially as a publicly traded company, right now they have to disclose a lot more too. So there's lots of, I would say, protections in place. So as an exchange, I think it's great. Personal opinion. I'll leave it at that. So another question on crypto around cold storage and how much do you keep on an exchange? So it's going to come down to personal preference, really. I feel very confident with Coinbase as a whole, but there is the whole mantra in crypto of not your keys, not your coins. And so should something down the road happen and you had funds on one of these exchanges, we just don't know what would happen to it. If you had funds in your own wallet that you controlled, you control it. Taking self-custody gives you that benefit of having direct control over it. It also adds an extra layer of responsibility on yourself because you need to manage your private keys. And if you lose them, you can lose access forever. So in terms of, the ratio, how much here, how much there, feel free to give us a call. Happy to talk personally with your situation on that. So
okay, so I'm back. Sorry about that. So the first question, the first comment was relative to the rates of automobile insurance going higher. And this individual pointed out that in their state, which is in California, there's a hiatus on how, like, I guess a freeze on how much they can raise property insurance because of the amount of natural disasters that California has experienced. However, that is not the case in the rest of the union. So in Florida, for example, they're raising house insurance rates exponentially. So this is like this rise in car insurance is car insurance. We can show next month the rise in house insurance and the fact that many people around this country, in Florida in particular, can no longer afford to pay their home insurance. Okay, and they're opting not to. And there are charts that speak to this. So what we will do next month is we'll actually break down by region, okay, what the insurance rates are for the different components, car, healthcare, and homeowners, because those are like the three biggies.
Yeah.
Even life insurance is going substantially higher. Okay, so this is just a trend. So yeah, maybe they're transferring some of their inability to pay higher premiums on home insurance in certain states like California, but they're not, that's not the experience across the rest of the country. So good question, and we'll definitely break that down for you next month. The next question, this particular individual is green oriented. So we always make sure that this person's portfolio is indicative of not having too much exposure in energy. Okay. So do know, please, that if any of you are not interested in any of that, we're certainly going to do that for you. But let us speak, because the point being is we know that there's this push towards electric vehicles. Okay. Now, what we want to point out to you is that the unfortunate truth is the demand and the increase in use of coal has increased. So
you look at a country like Germany, who shifted away from using nuclear power,
which is clean energy.
Which you could argue is extremely clean energy,
right?
Actually. But now their use of coal and their overall CO2 emissions have reached new highs, new peaks that they've never, producing more of these externalities now than before, even with the massive increase of wind and solar.
And they are exporting this from countries like the United States, okay, from countries like Canada. So now not only are they using more coal, but we're transporting it to them.
Right.
Okay, so I think all of you know my home is off the grid, and Paul actually also is very
awesome
efficient,
and
we are here at this company, but it can't be pushed and forced before we actually have resolution and good technology that allows us to do this. Because in it being forced, this person brought up that gas at the pump is $6 a gallon. Yes, because policy is getting ahead of the technology and the ability to roll this out. We would love to see nothing more than us getting green, but truly green, not green because we're just slamming it down people's throat. No, that's not the way to do this. There's got to be better technology. I'm going to give an example. In the 80s and in 1980s, there was a car called the Honda CRX high fuel HF that got 82 miles to the gallon in the 80s. Okay. There is no reason we cannot bring that technology forward. Something is stopping that. And maybe it's the energy companies, maybe not. Either way, I assume it is. But either way, we cannot leapfrog from here to here without a real plan, because for many of you in this chat, we're fine. We could put that energy in our car. We could put that in our car. But most Americans are getting to a point where they cannot.
Right. You have to understand that current policy around this is inequitable in the sense that it disproportionately impacts lower socioeconomic rings of our society, where if the price of gas goes up 50 cents, we can deal with that. But if a substantial portion of your paycheck goes to fuel so that you can get to the job that you need to put food on the table to feed your family and pay your rent, but now your gas cost has gone up, you're in a much worse situation. And so without having these thoughtful policies in place,
right,
in order to make this smooth transition, instead of saying, hey, we're just going to stop investment in oil and gas, and we're going to force everyone in 2050 or 2030, whatever the goals are, to move to all these electric vehicles, without any thought given to, okay, we have a 60-plus-year-old infrastructure grid that is severely lacking, that cannot handle the capacity of the electrical requirements. So that it creates more problems.
And so what we're seeing is a pushback. We're starting to see a pushback on electric vehicles because the consumer experience, fires in the garage and thus the house, people trying to travel and having to stop. Another trend that's happening with these electric cars is if you're in a larger city, you're in New York, you're in Boston now, you have to pay $35 just to enter the garage so that you can now charge your car. That's happening in some cities across the country. So there's a whole economics piece with this. Again, we want to see thoughtful policy in this direction, but not policy that's disenfranchising greater and greater groups of people. In the meantime, when you see what's happening in the Middle East and only the acceleration of this, then that tells us that we need to look internally, which these gas companies do. And again, we won't do this for people who don't want those things, but if you do, we're going to look at it. Please understand, if you look at the demand for coal, it's going higher. There is a facility. Which company was it, Paul, in the Midwest? Paul, do you remember the company that there's a company in the Midwest, and I can't remember what company it is. But they have to build a coal plant. They moved there or something like that so that they can run their entire facility on a coal plant.
It was a battery manufacturer.
It's a battery manufacturer for cars, had to move to an area where they're using coal to make their batteries. Okay, so we have to look at the whole thing in context. That's what we do. We can't be, our job, Paul and I, is to not be emotional about it or linked in too much, but to actually pay attention to
look
trends.
At the data, right?
Yeah, we just have to look at the data. The data is going to tell us all kinds of information.
Maybe for the next presentation, I was trying to find the chart that shows energy demand globally and how much of it is made up of oil, gas, and then renewables were here. And the trajectory is to go like this. And so they're talking about doubling or tripling renewables, which is wonderful, but that's still only is on a trajectory up here. That's still only this much of all of this. How are you going to replace all of it?
And then we have to get into the subject of like how safe really are renewables, really. I mean, how efficient are really renewables? And that's starting to come out now too. Did you answer these questions, Paul? You did? Okay. Are there any other questions, you guys? Like, again, call us directly if you have any questions. We're always here. Maybe the phone is ringing, so somebody's going to ask another question, which we can answer privately.
Anything that comes up, or you want to go further into any of these topics, give us a call. I'd love to talk about this stuff.
Next month we're going to do like a small business overview, because really that's, again, like we said, a big lifeblood of our economy. And then we'll do some things on this alternative energy space. So
all right.
Yeah.
Well, thank you everybody for joining us. Enjoy the rest of your day.
Yeah. Take care, everyone.
Talk soon.
Yeah. Thanks.